Welcome to Luxo-Life, your partner in life. Today, we're going to give you the tax secrets of the wealthy. 15 ways the rich legally pay less. If you want to learn how the wealthy grow their fortunes while paying less in taxes, stay with us till the end. We'll discuss the legitimate methods they use to reduce their tax bills. Show Luxo-Life some love, and let's get started. 15. Gifting up to $15,000. Rich people can gift money or items valued up to $15,000 to each recipient without having to pay taxes on those gifts. This allows them to share their wealth with family, friends, or charitable organizations while staying within the limits set by tax laws. This strategy is particularly useful during special occasions like weddings, birthdays, or holidays when giving gifts is customary. It can also be an effective way to help loved ones financially without impacting their own tax situation. The rule that allows gifts of this size without taxation is known as the annual gift tax exclusion. Each year, individuals can give away this amount to as many people as they want without incurring any tax liabilities. A wealthy person can gift $15,000 to each of their children, grandchildren, or friends without worrying about taxes. This approach not only helps to transfer wealth, but also enables the giver to support their loved ones in a meaningful way. 14. Charitable donations. Charities. Of course, charities play an important role in our communities by providing support to those who need. When wealthy individuals choose to make donations to qualified charities, they not only help others but can also benefit from tax deductions. This means that the money they can give can lower their taxable income, which ultimately reduces the amount of tax they owe. It's a way for them to make a positive impact while also being smart about their finances. When someone donates to a qualified charity, they can often deduct the amount from their taxable income when they file their tax returns. For instance, if a person donates $10,000 to a charity, they can reduce their taxable income by that same amount. This deduction can lead to significant tax savings depending on their tax bracket. Moreover, many wealthy individuals are passionate about certain causes, so their contributions can support organizations that align with their values. 13. Tax-exempt municipal bonds. 13th on our list is tax-exempt municipal bonds, which are an appealing investment option for wealthy individuals. These bonds are issued by state or local governments to fund public projects like schools, highways, or parks. One of the key advantages of investing in municipal bonds is that the interest earned from them is often exempt from federal taxes. This means that investors can keep more of their savings, making these bonds an attractive choice for those looking to grow their wealth. When wealthy individuals invest in municipal bonds, they typically receive regular interest payments, which can provide a steady income stream. Because the interest is tax-exempt, the overall return on investment can be more favorable than other taxable options such as corporate bonds or stocks. This characteristic makes municipal bonds particularly appealing for those in higher tax brackets, as it allows them to maximize their earnings without the burden of additional taxes. Number 12. Using tax credits. Tax credits can directly reduce the amount of tax owed, making them a powerful tool for lowering tax liability. Unlike deductions, which only reduce the amount of income subject to tax, tax credits subtract directly from the total tax bill. This means that if someone qualifies for a tax credit, they can decrease their tax payment dollar for dollar. For wealthy individuals, taking advantage of available tax credits can lead to significant savings. There are various types of tax credits available. Each comes with specific eligibility requirements. Some credits are designed to encourage certain behaviors, like adopting energy-efficient practices or investing in education. For example, credits for renewable energy installations can help offset the cost of solar panels or electric vehicles. By utilizing these credits, wealthy individuals can not only save money on taxes but also contribute positively to environmental sustainability. Additionally, some tax credits are refundable, meaning that if the credit exceeds the tax owed, the individual can receive a refund for the difference. This feature makes tax credits especially appealing, as it can result in a cash benefit beyond just reducing tax payments. This aspect of tax credits can be particularly advantageous for those looking to maximize their financial strategies while minimizing tax liabilities. 11. Educational savings plans. Contributions to educational savings accounts can grow tax-free, providing a valuable way to save for education without immediate tax consequences. These accounts, often known as 529 plans, are specifically designed to help families save for future educational expenses. By using these plans, individuals can contribute money that will be used for qualified educational costs such as tuition, books, and room and board while enjoying significant tax benefits. One of the key advantages of educational savings accounts is that the money invested grows tax-free over time. This means that as the account accumulates interest or investment gains, those earnings are not taxed. When it comes time to withdraw the funds for educational purposes, the withdrawals are also tax-free. This can make a considerable difference in the amount of money available to pay for education, allowing families to maximize their savings potential. Number 10. Healthcare Savings Account or HSAs. HSAs are healthcare savings accounts that offer a smart way to save for medical expenses while enjoying tax benefits. These accounts allow individuals to make contributions that are not subject to federal income tax, which means that the money you put in can grow without being taxed. This feature makes HSAs an appealing option for those looking to manage healthcare costs efficiently while also reducing their overall tax return. One of the standout benefits of HSAs is that not only are the contributions tax-free, but withdrawals for qualified medical expenses are also tax-free. This means that if you use the money in your HSA to pay for eligible costs such as doctor benefits, prescription medications, or certain medical procedures, you won't have to pay taxes on those withdrawals. This tax-free aspect can lead to significant savings over time, especially for individuals or families who have regular healthcare expenses. Another advantage of HSAs is that they can serve as a long-term savings tool. Any funds that are not used in a given year roll over to the next, allowing the account to grow. Additionally, once you reach a certain age, you can use the funds for non-medical expenses without penalty, although those withdrawals will be taxed as regular income. This flexibility means that HSAs can serve as a financial cushion for both current and future healthcare needs. Number 9. Retirement accounts for tax-deferred growth. Contributing to retirement accounts allows for tax-deferred growth, meaning taxes are only paid upon withdrawal during retirement. This strategy can be a powerful way to save for the future while minimizing tax liabilities in the present. When individuals put money into retirement accounts like 401ks or IRAs, they don't have to pay taxes on those contributions right away, allowing their investments to grow without the immediate tax burden. One of the main benefits of tax-deferred growth is the potential for compounding returns. When your investments grow without being taxed each year, you can reinvest those earnings, leading to even more growth over time. This compounding effect can significantly increase the total amount saved for retirement. For many people, the earlier they start contributing to these accounts, the more they can take advantage of this powerful financial principle. Number 8. Annuities for tax-deferred income. Annuities also provide a way to invest for tax-deferred income, making them an appealing option for individuals looking to grow their wealth without facing immediate tax consequences. When you invest in an annuity, your money can grow over time without being taxed until you start receiving payments. This feature allows your investment to accumulate more value, as you don't have to worry about taxes eating into your returns year after year. One of the key benefits of annuities is that they can offer a steady stream of income during retirement. Many people choose to invest in annuities because they provide guaranteed payments for a specified period or even for the rest of their lives. This can help individuals create a reliable income source in retirement, which can be especially comforting for those who want to ensure they won't outlive their savings. Number 7. Using trusts and estates for tax planning. Trusts are legal arrangements that can play a crucial role in tax planning and protecting assets. By establishing a trust, individuals can effectively manage their wealth and ensure that their assets are distributed according to their wishes after they pass away. One of the primary benefits of trusts is that they can help avoid or reduce estate taxes, which can be quite significant. This means that more of an individual's hard-earned wealth can be passed on to their loved ones instead of being lost to taxes. In addition to tax benefits, trusts also provide a layer of protection for assets. When assets are placed in a trust, they are managed by a trustee who has a legal obligation to act in the best interest of the beneficiaries. This can be particularly important when it comes to protecting assets from potential mismanagement by heirs. If there are concerns about an heir's ability to handle their inheritance wisely, a trust can ensure that the assets are managed and distributed responsibly according to specific guidelines set by the trustor. Number 6. Claiming yachts or motorhomes as secondary homes. Did you know that you can take advantage of tax benefits by classifying yachts or motorhomes as secondary residences? Some wealthy individuals do just that to enjoy various tax perks. By claiming these luxurious items as second homes, they can write off certain expenses related to maintenance and usage. This approach allows them to reduce their taxable income while still enjoying their recreational vehicles. One of the key benefits of this classification is that they can provide deductions for mortgage interest and property taxes similar to what homeowners enjoy. For those who qualify, this can lead to significant savings. Instead of simply treating these items as toys, wealthy individuals see them as valuable assets that can contribute to their financial strategy. This method allows them to leverage their lifestyle choices to enhance their financial position. However, it's important to understand the rules and regulations surrounding this practice. To qualify, the yacht or motorhome typically needs to meet specific criteria, such as being used for personal purposes for a certain number of days each year. Failing to adhere to these requirements could result in losing the tax benefits, so proper record keeping and adherence to guidelines are essential. Many wealthy individuals consult with tax professionals to ensure they navigate these regulations correctly. Number 5. Depreciating assets on paper. Fifth on our list is the strategy of depreciating assets on paper. This approach is particularly useful for businesses looking to lower their taxable income. When a business buys an asset, like equipment or vehicles, the value of that asset decreases over time due to wear and tear. By acknowledging this decrease, businesses can claim depreciation, which helps reduce their overall taxable income and, in turn, the taxes they owe. The process of depreciation allows businesses to spread the cost of an asset over its useful life. For example, if a company purchases a piece of machinery for $100,000 and expects it to last 10 years, it can depreciate the asset by $10,000 each year. This not only reflects the reality of the asset's decreasing value, but also provides a significant tax advantage. By lowering taxable income, businesses keep more money in their pockets, which can be reinvested into the company. Number 4. Using art and equity as non-taxable income. Instead of taking a traditional salary, many wealthy individuals choose to receive equity compensation, which can be a smart financial move. Equity compensation means that instead of cash, they receive shares or ownership in a company. This form of income isn't taxed until the shares are sold, allowing them to keep more money in their pockets while their investments grow. This strategy can be particularly appealing for those involved in startups or companies with high growth potential, as it allows them to benefit from the company's success without facing immediate tax liabilities. In addition to equity, buying art can also serve as a savvy investment strategy for the wealthy. Many see art not just as a beautiful addition to their homes, but as an asset that can appreciate over time. When art increases in value, the owner can sell it later for a profit. The gain from selling art can be often reinvested into more art or other investments, providing a tax-efficient way to grow wealth. Just like with equity, the tax on the profit is only incurred when the artwork is sold, allowing for greater flexibility in financial planning. Art investments can also provide additional benefits beyond just potential appreciation. Many wealthy individuals enjoy the cultural and aesthetic aspects of art, making it a passion project as well as a financial strategy. This dual purpose can enrich their lives while also serving as a valuable asset. Owning unique pieces can create opportunities for social connections and networking, further enhancing their overall wealth-building strategies. Number 3. Borrowing against assets. Borrowing against assets is a common strategy among wealthy individuals. Instead of selling their investments such as stocks or real estate, they can take out loans using these assets as collateral. This approach allows them to access cash when needed without having to liquidate their investments, which could trigger tax liabilities. By doing so, they can maintain their investment options while still obtaining the funds necessary for expenses or new opportunities. This method can be particularly advantageous because it helps wealthy individuals avoid capital gains taxes, which are typically incurred when selling appreciated assets. For instance, if someone has seen significant growth in their investments, selling those assets could result in a substantial tax bill. By borrowing against them instead, they can access cash without facing immediate tax consequences. This flexibility enables them to manage their cash flow effectively and make strategic financial decisions without the pressure of selling. Number 2. Moving to tax-friendly countries. Relocating to countries with low or no income tax can significantly reduce tax burdens. Many individuals consider this option to keep more of their hard-earned money. By moving to tax-friendly countries, they can take advantage of favorable tax laws that allow them to save a considerable amount of taxes each year. This strategy is especially appealing to those who have the flexibility to work remotely or manage their investments from anywhere in the world. Countries like Monaco, the Bahamas, and certain regions in the United Arab Emirates have gained popularity for their attractive tax policies. These places often do not impose income tax, allowing individuals to retain a larger share of their income. By making this move, wealthy individuals can dramatically increase their disposable income, which can then be reinvested into businesses, savings, or lifestyle choices. It's a smart financial decision that can yield significant long-term benefits. And number 1. Using blockchain technology for tax control. Lastly, blockchain technology has the potential to change how we think about taxes. This innovative technology can offer greater control and transparency over how tax dollars are allocated. By using blockchain, governments could create systems that allow citizens to see exactly where their tax money is going, making it easier for everyone to understand how funds are used for public services and infrastructure. One of the key advantages of blockchain is its ability to provide a secure and immutable record of transactions. This means that once a transaction is recorded, it cannot be altered or deleted. For tax purposes, this could help reduce fraud and ensure that all tax payments are accurately tracked. With a more reliable system in place, individuals may feel more confident that their tax contributions are being used effectively and responsibly. Additionally, blockchain can simplify the tax reporting process. Instead of dealing with complicated forms and endless paperwork, individuals and businesses can use blockchain to automatically record their financial transactions in real time. This would streamline the tax filing process, making it less burdensome and reducing the chances of errors that could lead to audit or penalties. That's a wrap on the 15 ways the rich legally pay less. We hope you found these insights valuable. If you did, please give us a thumbs up, share your thoughts in the comments, and spread the word. If you're new to Luxo-Life, subscribe and hit the bell icon for updates. Thanks for watching and see you next time, Luxo lovers!